Walmart is a potential bellwether of the U.S. economy and U.S. stock market as a whole, so I think it is worth listening to. What does Walmart have to say? Well, clearly nothing great, because Walmart stock is down over 10% today following their first quarter 2022 earnings. What's going on with their earnings? Well, you see continued, slow growth. You see margin pressure. This is the inflationary pressures. And you're seeing operating earnings take a big hit. But aside from just looking at Walmart, I think it has bigger ramifications for a lot of U.S. stocks. And this gets back to that point of being a bellwether. It has a lot of potential read-throughs for the U.S. economy and also your portfolio beyond Walmart, talking about employment, talking about consumer behavior, talking about business investments. We're going to talk about all these aspects in this video, partly reading through Walmart's results. So we're going to look at Walmart's results, why they're down. So I just mentioned you're seeing inflationary pressures both hitting their margins as well as inflationary pressures as their costs, their expenses are going up. So a double whammy sort of hitting their results. And what that means for the U.S. economy and for the broader investment landscape that you might be looking at with your own investment portfolio. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel, so leave the hype at the door. In this video, we're going to be talking about Walmart, thinking about their valuation towards the end of this video, as well as the read-through potentially to U.S. stocks, U.S. economy. If you enjoy no hype, mission focused channel, please make a point. Unrivaled Investing, please make a point of hitting that thumbs up and hit that subscribe button. So let's dive right back in to understand what exactly is going on here. CNBC is calling out how Walmart shares are down following higher cost, supply chain problems, and inventories eating into profits. And that is the case, but there's a little more granularity to it. In order to understand Walmart's results, you should first understand that the vast majority of their operations is still U.S. So while they do have additional assets like their international operations or Sam's Club, their wholesale operations, the vast majority of their profits do come from their traditional U.S. stores. So why did margins in their U.S. segment face a nearly 20% decline? Now, part of this was over staffing, where they saw another wave of COVID coming. And I got to give management a lot of credit here for saying, hey, we want to make sure our stores are run at a certain standard. So we can have X percentage of our employees not there, because then, once again, store standards will drop. So we want to make sure staffing is fine. We see this COVID, wave starting to tick up. So as that happened, they wanted to make sure they had the staff in place, and they were expecting when employees got COVID that they would stay out for longer. That actually didn't happen. They ended up returning back to work sooner, as soon as as soon as they effectively could. And so it resulted in effectively this too many employees, overstaffing, resulting in higher expenses. But that's only one aspect. You do have, you have seen some core inflationary pressures like container ships and shipping goods around the world. That has gone up significantly as well. So there's a lot of different types of inflationary pressures that they call out. They also talk, so that going about the overstaffing, we had nearly all associates on COVID leave return in February. And so they weren't expecting that fast of a turnaround, but they now believe that they're staffed in a way that supports our top line performance. Okay, so the staffing challenge, that's likely a one-time performance hitting the stock. So that really shouldn't hurt the stock price like you're seeing today, where it's down about 10%. This might reflect a bigger issue where they're talking about the rate of inflation in food pulled more dollars away from general merchandise, GM, than we expected, as customers needed to pay for the inflation in food. This is actually really, really important, and this could have a direct read-through on your portfolio depending on how you're investing, which is that they're saying there's effectively this trade-off that consumers around the world are going to be making. They're seeing it in a pronounced way in the U.S. with its high inflation, where consumers are saying, yeah, my food budget, the cost just went up a lot. So all these other goods, these discretionary purchases that I traditionally might have purchased, you know what? I'm a lot less eager to do it because I don't even have the money to do it. My money's going on food, which is going up a lot. And so that could have a huge hit to revenue for all these other companies that, let's say, supply Walmart with this general merchandise, whether or not it's clothes, toys, what have you, electronics. So this is worth understanding, You are seeing a real-time trade-off with consumers. So yes, Walmart's still growing, but you have to look, underneath that first layer of growth and say, well, wait a second. This is part of the reason why margins are also taking a hit, is that they get lower margins on things like food versus, general merchandise, where you can mark it up a little bit more as it's a discretionary purchase. And so this is a little bit of a challenge here. Now, they also talk about how they saw a sizable 32% increase in inventory, higher than they want, and how they're planning on working through most of the excess inventory over the next couple of quarters. Now, this could also have a big deal, big ramification for, like, let's say the U.S. economy. And we'll talk about how much of an impact it could have. But broadly, as companies consider this, and Walmart is not the only one arguably facing this, potentially, hey, we have too much of this other inventory. We have shortages in some spots. We have too much inventory in these others. So this might give them pause to say, oh, discretionary goods, yeah, we may not need to buy as much of that. And so you also have this sort of thought process of, well, maybe we shouldn't be making these other types of investments. So there's all sorts of read-through when the consumer is actively making that trade-off saying food or everything else. Well, you still need food. That does have real consequences to companies. And so looking at what we're looking at with Walmart, Walmart is still posting 4% growth. And their this is their US business, and US is still around a $400 billion sales business. That is huge. This is a huge part of the US economy. When you look at total US GDP, US GDP is around 21 trillion. So compare it to annualized Walmart US sales of 400 billion. If they're talking about, oh yeah, we're potentially going to be easing on inventory because you know what, we built it up a little bit too fast. Now they do go through inventory turns quite quickly, but I think this is a broader, like, let's make sure we don't overdo it with a lot of general merchandise that may not be moving as quickly as, let's say, perishables. And so that is a really interesting point because all the suppliers to Walmart may now see a pause or slower cadence with orders. So that has a direct read-through to the economy as we think about this. And keep in mind, 400 billion relative to a 21 trillion dollar economy. You're talking about 2% of the U.S. economy. Talking about, hey, we're going to moderate our inventory or be more cautious with growing it. So another reason why Walmart stock is down is partly because of guidance. They lowered their guidance. They raised it on the revenue side. So saying, yeah, it's going to be slightly higher, but that's largely because of inflation. And they're saying, well, actually, if you look at our profitability, and keep in mind, a flat growth business or an inflation plus a little business, a lot of folks are focused on their profitability. And they're saying, actually, our profitability is going to be flat and may even be down a little bit year over year, which is really upsetting for a lot of investors, saying, well, wait a second, I thought you were going to pass through these costs. What's going on here? So how should we think about weighing the different fundamentals of Walmart? How should we think about the value of Walmart stock? First, a quick plug, where if you're either struggling with this current investment environment, where you're just trying to protect your savings, or you want to find potential multi-baggers, the types of stocks that could potentially go up hundreds or even thousands of % over time, please make a point of going to unrivaledinvesting.com. And it is the Unrivaled Investing subscribers that keep this channel alive. So a big thank you to all the Unrivaled Investing subscribers. And if you enjoy this content, please make a point of hitting that thumbs up, hit that subscribe button. Also, here's a disclaimer you can read on your own time. And so looking at Walmart's results, the reality is, as they call out, they continued to gain share in grocery. They have a very strong value proposition there. And consumers know, like, hey, this is about as cheap as I'm going to be getting it in a lot of cases. They're talking about price leadership is especially important right now. That's code for, yeah, the consumer's facing really some tough choices. And they're talking about one-stop shopping becomes more than just convenience. So this is saying, yeah, this is actually fitting right into our sweet spot because the consumer is in a pinch, so they need to get groceries, and you know what? They're not going to be in a position to go shopping around to 3 other stores. This is playing into Walmart's strength. So that is what I like to see, them talking about winning share in grocery. Even if grocery is lower margin, that is important. That does reflect that they continue to have a very strong value proposition. This means, in my opinion, that Walmart is not necessarily losing to a stronger competitor. What they are facing is a tough macro environment. That is a key point, and I think that's the reason why U.S. stock, yeah, the Walmart stock is going down, and it could have read through to U.S. stocks as a whole. And so we'll talk about that, that element. And so, but this is a key point, suggesting, here it is, Walmart's core value proposition is resonating. It is still very strong. Now, valuing Walmart, the reality is, you got a lot of different assets here. Even though the U.S. is the vast majority of the operations, they own the majority of Flipkart, the dominant e-commerce platform in India. They have operations all over the world, some of which are in Central America. They have an advertising platform called Walmart Connect that helps with omni-channel sales, effectively tracking whether or not the sales are occurring offline or online. They also have Sam's Club, which I already alluded to. But the reality is, Walmart as a whole is a much slower growth business, and it is closer to maturity in terms of their free cash flow. And so folks are valuing it based on how are they going to deliver on earnings. And so then looking at what's gone on with Walmart stock, the reality is Walmart's earnings multiple in the last year got bid up significantly. So partly what you're seeing now is a regression where effectively investors are saying, wait a second, this isn't a hyper growth company. This shouldn't get 25, 30 times forward earnings multiple. That doesn't make sense. This is a company that's tied to the economy. It's literally 2% of US GDP. How fast is this really going to grow? You're effectively going to be growing at inflation plus a little. You're going to be growing at whatever GDP is, maybe a little bit more. And so, and your profit margins are going to wiggle around a certain, small level, around 4%, give or take a little. So the concern here that I think investors might face is the reality that if you go back earlier in this decade, it was trading at a low teens multiple, where investors were saying, yeah, this growth isn't enough. And it's possible, once again, with all stocks, you always have three components. You have cash getting returned to you as a shareholder. You have valuation. Is the sentiment causing the valuation to expand or causing the valuation to contract? And so looking at it now, it's very clear, sentiment is starting to contract. The valuation multiple is starting to contract. And that last key component that drives, Walmart stock is the underlying fundamentals. And, you look at their fundamentals and they're certainly not penciling out hyper growth. So this is almost like treating it like a bond. What would you expect for this type of free cash flow? What would you expect for low sort of growth going forward? And also, with a bond, you get the certainty of payment. With a stock, there's less certainty because, hey, earnings are going to be fluctuating around. And you can see how earnings, their end earnings has actually declined. Their net income has actually declined over the last 3 years. Their operating profit, that's the one I would focus on, is actually up about 25%. But this is not a hyper growth business by any means. You're looking at very low margins, razor thin margins. This is a business, $600 billion in revenue, $400 billion of which about coming from their U.S. operations. So this is about 2% of the U.S. economy. And so looking at the current valuation, and keep in mind, once again, this is a hypothetical framework. Stock price can go way higher, way lower. Looking at Walmart, even after this 10% sell-off, and I'm saying to myself, it's around 4% operating margins that they can get, and it's around 25% tax rate, excuse me. And so you're still looking at around 20 times forward earnings for Walmart stock, and that's what we just saw in that last visual of the valuation chart. And so looking at where Walmart is and where they can be in the future, maybe their growth rate is somewhere between 3 and 7% in the ensuing years. Maybe their end multiple, looking at the range once again that we saw this last decade, maybe it gets down to a low of 13 times because folks say, well, wait a second, where's the growth here? Versus a high of maybe 19 times, which is slightly lower than where it currently is. Keep in mind, this is 5 years out. And so looking at this, the risk reward just really isn't that compelling. You're effectively saying upside of 40%, downside of 40%. Now, what does sort of tilt this in the investor's favor slightly is the fact that you do have meaningful cash accrual because they are still generating around $15 billion in free cash flow a year, give or take, that does go to the shareholders. And that's through buybacks and that is through dividends. But looking at the core fundamentals here, the stock price isn't crazy compelling. Now, keep in mind, this is a potential of what they could do if management executes. If they don't execute, stock price can go way lower. If sentiment gets even worse, stock price can go way lower. So a lot of the questions are, if you own Walmart stock, are you confident that this is going to be growing greater than 7% in the years ahead, much faster than where they are now, faster arguably than the U.S. economy, and will they be able to expand their margins, let's say beyond 4.5%, when in fact they're facing margin pressure right now across the board? So I look at Walmart and I'm saying, you know what, this is another example of why the U.S. indices could come under pressure, as Walmart is a big company. This is a $300-400 billion company. Wouldn't surprise me if Walmart goes nowhere for the next 5 years based on the current stock price, even though it's down 10% today. And so I think there are other read-throughs to U.S. stocks, because earlier I alluded to this, risk of, hey, does this mean, as Walmart is a potential bellwether of the U.S. economy and U.S. stocks, does this mean you should be getting out of stocks? Well, let's consider the different economic read-throughs from Walmart. First of all, they effectively said they were overstaffed previously. So that means any sort of unemployment trend is more likely to go in the wrong direction, because they're not in the business right now of saying, hey, we need to staff up. Okay, so that's one data point that's not favorable. Another data point, the consumer is looking at a trade-off, a real-time trade-off between food and everything else. And they're saying, yeah, I still need to eat. And so that is a problem when you look at pretty much the rest of the economy, because as the consumer is saying, and that's the vast majority of the economy, is the consumer is facing this trade-off, everything else is going to face pressure. So that is a huge read-through and a huge warning to, I'd argue, U.S. stocks and potential valuation multiples. Because as companies start calling out, you know what, there is this pressure from the consumer, their valuation multiples will also come under pressure, because they're no longer going to be penciling out as high of a growth rate. And so you do start seeing this double whammy, this sort of dance where, yeah, fundamentals get hit, and then secondarily, you also start seeing sentiment come under pressure. So then you also see, Walmart talking about their inventory, how their general merchandise built up too much, partly because, once again, people were buying food versus buying apparel. And so then they're saying, yeah, we're going to be more cautious about loading up on inventory. So all the suppliers for Walmart, yeah, that means they're going to be getting less orders from Walmart, or Walmart's going to certainly be slower in terms of, putting in those orders. So that is worthwhile to think about. Another hit to everything that's non-essential to the economy, to the consumer. So any sort of growth investment, Walmart's saying, yeah, our margins are coming under pressure. So if they're thinking about making additional growth investments, Walmart, I think, is trying to have best practices. And they're saying, yeah, we're probably just going to invest through the full cycle. But a lot of businesses don't have that $15 billion in free cash flow a year. And so they might say, you know what, if margins are coming under pressure, we're not in a position to expand. We're not in a position to make those growth investments, whether or not it's opening a new factory or a new store or something like that. So once again, that has read through. So I'm looking at this and I'm saying there is significant warning signs and implications for U.S. stocks. And so I think when you're looking at various different businesses in this environment, I personally want to see a much better risk reward for what I'm owning. I want to see those things where it's, 100, 200, 300% upside versus 40% upside, 40% downside. I also prefer to see things that are necessities. A company that sells insurance that is critical for several businesses. Even if a business is coming under pressure for margins, they still need, let's say, property and casualty insurance. So that is a necessity. And if anything, they could benefit from inflation. So that's an example of a business that should sort of ride that wave, keep growing. But a lot of other businesses, that discretionary purchases, those businesses could come under pressure. I would be a lot more cautious on it. So this also means, as I personally go through my portfolio, reflect on, okay, what's a necessity? Okay, healthcare. Healthcare is a necessity. That's another example. What's not a necessity? And so to parse out, what are the decisions where businesses might say, you know what, we don't have the growth budget to make an allocation here, but we certainly have to keep it, over here. We certainly have to keep up our necessities. So this is a tricky dance that I think a lot of investors are going through. This is not a traditional, bull or bear cycle that you're seeing here. You're seeing strong inflation and you're seeing sort of cross currents with the underlying consumer, with the underlying economy. So if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. I am not a bull on Walmart stock. I think it's another example of why the U.S. indices could be under pressure for years to come, and why I think it's so important to try to find exceptional companies, unrivaled investments, the types of companies that could grow through the full cycle. That's at least what I'm personally looking for. You can check that out at unrivaledinvesting.com. If you enjoyed this video, please make a point once again of hitting that thumbs up, hit that subscribe button. Thanks for watching.